Okay, so good day everyone. So our topic for this about index-linked bonds. So of course, in this topic, we're going to discuss about on how or why use an index-linked bond is important. No, again, bond investors earn a fixed rate, no, of return on the capital that they contribute. So the coupon rate determines periodic interest payments received by bondholders. So, however, in an inflationary environment, the real value of cash or cash flows earned through fixed coupon payments decline. No? Therefore, index-linked bonds are used as a hedge against inflation to secure the purchasing power of income earned through bonds. Okay? So to give us more details about the topic, of course, let us all welcome our presenter. Wait, I just want to share it.
Good evening po. Ako po si Marita Saronimo, magre-report po about index-linked bond. An index-linked bond is a bond in which payment of interest, income of the principal is related to a specific price index. Usually, the Consumer Price Index or CPI. This is features provided protection to investor by shielding them from changes in the underlying index. An index-linked bond is a bond in what is an index bond? Surprise. Ano na po? Next slide po. What is an index-linked bond? An index-linked bond is a bond in which payment of interest income on the principal is related to a specific price index, usually the Consumer Price Index or CPI. These features provide protection to the investor by shielding them from changes in the underlying index. The bond cash flow are adjusted to ensure that the holder of the bond receive a known real rate or return. An index-linked bond is also known as a real return bond in Canada. Treasury inflation protected securities or TIPS in the US and linker in the UK. An index-linked bond is used to protect the income earned by bond investor against inflation. Index-linked bonds are linked to a country inflation index. For example, the UK issue index-linked bonds called linkers that are linked to the retail price index or RPI. Similarly, Canada use real return bonds or RRBS that are linked to the consumer price index or CPI. This is the bar graph growth of the universal ILB market. Dito po makikita kung ano po yung mga taas po, kung sino po yung pinakamas mataas po yung benta. The practical example, let's consider an example to understand the construction of index-linked bonds and arrive at the real interest rate. In this example, the Consumer Price Index or CPI will be used as a measure of inflation. Bond CFI was issued at the face value of $1,000 at an annual coupon rate of 10,000% and with a maturity of 1 year. The Consumer Price Index or CPI when the bond was issued was 170. A year later, CPI equals 175. Calculate the indexation factor and inflation rate. The indexation factor represents inflation and is used to adjust the bond principal. In the example, it will be calculated by dividing the bond CPI and maturity by its CPI at the time of insurance. Indexation factor, CPI and maturity or CPI at insurance is equal to 170 or 175 or 170 is equal to 1.0294. An indexation factor of 1.0294 indicates that the inflation rate is 2.94%. The figure can be confirmed by calculating the percentage change in CPI. Inflation rate is 175 minus 170 divided by 170 equals to 0.0294 or equals 2.94%. As seen as above, the percentage change in CPI confirms that inflation is 2.94%. Calculate the cash flow from the bond at maturity. At maturity, the bond would pay out its face value at manual interest. The interest payment is product of the annual coupon rate at face and face value. Cash flow from the bond and at maturity, face value plus interest, payment equal $1,000 plus $1,000 times 0.10 is equal to $1,100. Step 3, multiply the bond's cash flow from the maturity with the indexation factor. The product in the total amount received by investor when the security expired. Amount received at maturity is equal to $1,100 times 1.0294 equals to 1,132.34. The total amount received by a bondholder and maturity will be $1,132.34. This amount includes the different face value is $1,000. Annual interest payment is $100 and the amount adjusted to inflation is $32.34. Step 4, calculate the nominal interest rate. The nominal interest rate is in the percentage change between the amount investor received, the maturity, and the face value. The amount they contribute while purchasing the bond from the issuer. Nominal rate, interest rate is equal to $1,132.34 minus $1,000 or $1,000 is equal to 13.23%. Calculate the real interest rate is according to Irving-Fisher calculation. The equation below illustrates the relationship of real interest rate, nominal interest rate, and inflation. The real interest rate is equal to nominal interest rate minus inflation rate is equal to 13.23%. Less 2.94% is equal to 10.29%. The real interest rate for this index-linked bond is 10.29%. An index-linked bond is a bond which is coupon payment adjustment has surpassed. Next slide na po. Example of an index-linked bond, consider the two investors. One purchases a regular bond and other buy an index-linked bond. Both bonds are issued and purchased for $100 during July 2009, having the same terms, 4% coupon rate, 1 year to maturity, and $100 face value. The CPI level at the time of insurance is 204. The regular bond pay an annual interest of 4% or $4 is $100 times 4%, and the principal amount of $100 is repaid at maturity. At maturity, the principal and the interest payment due that is $100 plus $4 is equal to $104 will be created to the bondholder. Assuming the CPI level in 2002, July 2020 is 207. Interest principal value must be adjusted for inflation with the index-linked bond. Coupon payment are calculated using an inflation-adjusted principal amount, and an indexation factor is used to determine the adjusted principal amount. For a given date, and the indexation factor is defined as the CPI value for the given date divided by the CPI at the original issue date of the bond. The indexation factor in our example is original issue date of the bond 1.0147 207 over 204. There are inflation rate in 1.47% at the bondholder will receive $105.53. $104 times 1.0147 when immature. The annual interest rate in the bond is 5.53% times $105.53 minus $100 divide or $100 times 100%. The investor appropriate real return rate is 4.06 by 5.53% minus 1.47% calculated as the nominal rate less the inflation rate. The government of the country issued in April 2008 with maturity after exactly 3 years and coupons at 8.25%. PAs payable yearly in the areas. The coupons and redemption amount are linked loan inflation index with a 1-year time lag. The index value at 1st April of each year will as follow. Year is 2007, the index is 158. And 2008, the index is 167. Year 2009, the index is 175. And the 2010, the index is 190. Calculate the price an investor would have paid in order to achieve a real yield of 7% of payable. Next po, sir. Bali, ito po yung magiging total po niya. Yung year po ng 2000 is negative po. Yung 2009 po, yung nominal cash flow po niya is 8.25. Yung actual cash flow po niya is 8.719936709. The real cash flow po niya is 8.3213111031. And the discounted real cash flow niya is 7.77692697. Sa year 2010 naman po, yung nominal cash flow po niya is 8.25. Yung actual cash flow po niya is 8.9077844.1. Real cash flow naman po niya is 7.205.421,386. And discounted real flow po niya is 6.293499092. And then 2011 naman po is 108.25 po yung nominal cash flow. Yung actual cash flow naman po is 130.1740506. And the real cash flow is 94.5176824. Discounted real cash flow is 77.15458.71. The total is 91.225002. Ang summary po is index-linked bonds are fixed income security tied to an inflation index to protect the real value of cash flow during the inflation. The UK issue linkers and US issue treasuries inflation-protected securities or TIP and Canada issue real return bonds RRBS. They are usually constructed by adjusting the bond principal to inflation figure. Mag-a-add lang ako, sir, ng key takeaway po. Index-linked bond is also Treasury inflation protected securities in US pay interest that is linked to an underlying index such as a consumer price index or CPI. Index-linked bonds are issued by government to help mitigate the impact of inflation, paying a real yield plus accrued inflation. These bonds are beneficial to investors because they are less volatile than normal bonds, and the risk involved with uncertainty is reduced. Thank you po.
Okay, so thank you very much, presenter. No? Again, as what our presenter mentioned, no? An index-linked bond is used to protect the income earned by bond investors against inflation. So, index-linked bonds are linked to a country's inflation index. No? Let's say, for example, now the UK issues index-linked bonds called linkers that are linked to the retail price index. No? So, yung RPI. So, similarly, let's say, Canada issues real return bonds o yung RRBS nila that are linked to the consumer price index. No? So, in this discussion, we will be able actually to understand the index-linked bonds are fixed income securities tied to an inflation index to protect the real value of cash flows during inflation. A while ago, I mentioned about the UK issues linkers. No? So the US issues Treasury inflation protected securities, yung tips nila, and Canada issues real return bonds or RRBS. They are usually constructed by adjusting the bond's principal to inflation figures. Now, so why use an index-linked bond? Bakit nga ba? So, bond investors earn a fixed rate of return on the capital that they contribute. So, the coupon rate determines periodic interest payments received by bondholders. However, in an inflationary environment, the real value of cash flows earned through fixed coupon payments declines. So therefore, an index-linked bonds are used as a hedge against inflation to secure the purchasing power of income earned through bonds. Now, again, index-linked bonds were first issued during the American Revolution, no, 177 to 1783. No? So the U.S. government financed the war by printing currency, which increased annual inflation to 30%. So to protect interest income, Massachusetts issued an index-linked bond where payments were linked to a basket of goods and services representative of inflation. So in 1981, no, the UK was the first industrialized nation to adopt index-linked bonds. No? Soon adopted was followed by the Sweden, Australia, and Canada. So in 1997, the US began issuing treasury inflation protected securities, which comprise a treasury bonds that is linked the consumer price index. No? So now, how will be able to what will be the construction of the index-linked bond? No? Again, as our presenter mentioned, no, index-linked bonds are composed in two ways. Number one way involves adjusting the coupon rate to match inflation and keeping the face value constant. Such index-linked bonds are called C-linkers as the inflation link is attached to coupon. So C-linkers are often used by commercial banks and life insurance companies. No? So the second kind of index-linked bond is constructed by adjusting the principal based on inflation and recalculating coupon using the adjusted principal. Such index-linked bonds are called P-linkers. No? A while ago, C-linkers. This time, P-linkers. No? As the inflation link is attached to the principal. That's why it's called P-linkers. No? So P-linkers are usually issued by government. And most index-linked bonds in the market are P-linkers developed by adjusting the principal to inflation figures and again, recalculating the coupon. So actually, a while ago, our presenter gave us a lot of example on how we'll be able to get the consumer price index. No? So I'll just want to try if I could able to share first this one, a video on how we'll be able to compute the consumer looking forward, no? Because, wait. So I just want to share this one regarding on how we'll be able to compute, no? As what I mentioned earlier, the consumer what do you call this one? Price index na consumer or CPI. The CPI.
So while watching this video, make sure to use the guided notes. You can find the guided notes in the description below. The guided notes go along with the video and it'll help you understand the content better. So let's just start talking about CPI, a consumer price index. We're going to cover this first and then we'll get into inflation. Now, a consumer price index is used to kind of see what's happening with inflation. Now, we're going to have a base year for this. When we're looking at inflation, we have to understand that the value of money changes over time. And when we have inflation, that means our purchasing power is going down. So a consumer price index is used to kind of see what's going on with inflation with a certain basket of goods. Normally we'll have the same goods compared in a CPI every single year. So that way we can see how the value of those goods has changed. If those goods cost more, we've seen inflation. If they've cost less, then we might see deflation occurring. To calculate this out, we first have to create a CPI. First thing we'll have to do is select a base year. That's step one. Step two is we'll need to actually select what's going to be in our basket of goods. Step three, we'll record all of the different prices for each of our years. And then we'll times that by the quantity. So we'll be able to see exactly how much our basket costs. Step four is the math part. Now, before you freak out about math, it isn't that bad. We're going to use this formula. Our CPI will equal the current value of our market basket. So this is referencing whatever year we're trying to find. And then we're going to divide it by the base year. Now, I've already referenced the base year, but a base year is going to be the year that we're going to use that value. This value, whatever our base year is that we decide to pick, that is going to then be the value that we'll compare of our money to all the other years. After dividing, we times it by 100, and this is going to get our CPI. Now, this isn't necessarily a percent, it's an index number, but it does show us a percent change compared to just the base year. Not between year to year, but it shows what's happened with the value of money in comparison to our base year. So let's actually look at this in practice and kind of see what we're talking about. It's easier to visualize it when we're actually seeing the numbers firsthand. So over here right now you can see I have a couple different years. I have 2014 all the way to 2019. Now, one of the important things to realize here is we've selected this base year at 2015. Now, what this means is this is the year I'm going to use to compare that value of the basket to everything else. One thing to note, the CPI for the base year will always be 100. Every single time, the base year will be 100. Remember that. And the reason why is if I'm looking at the value, if I'm trying to calculate out what's happening with our CPI, I'm going to use the formula we talked about earlier. I'm going to take the current value of the market basket and divide it by the base year. Well, if I'm talking about the base year, I'm dividing the same thing by itself. So for here, I'd be taking 25 divided by 25. That's going to give me 1. And then I would times it by 100. So my base year is 100. The CPI, 100. Now, try to figure out what the CPI would be for all the other years. Remember the formula. The formula is our current market basket, whatever year we're trying to find, divided by the base year market basket, and times that by 100. Pause this video and try to figure it out. Did you get it? Check your answers right now. You can see the answers on the screen. One of the things to note is when we're looking at this, we're not seeing the inflation rate between every single year. We're seeing it in comparison to our base year. So for example, if I'm looking at 2016, I have a CPI of 120. That means I've had 20% inflation since my base year. If I look at 2017, I can see it's 160. This means that I've had a 60% inflation rate from the base year, not from 2016. The next thing we're going to go into is actually how to find an inflation rate between years. This is again just showing us what's happening between the base year with inflation. Hopefully the CPI is making sense, how to find it. It isn't too bad. It's just important to understand the formula and what's going on. One other thing to note is if we're ever going below 100 now, like we can see for 2014, we're actually seeing deflation. Our value is going the opposite way. Instead of inflation occurring where we're losing purchasing power, we're actually seeing it where we're gaining purchasing power. Our money is worth a little bit more. So that's something to consider. Now, let's go on to the next thing where we'll actually look at how to find the inflation rate between 2 years. So when calculating out the inflation rate between 2 years, we're going to use the following formula. We're going to have our year 2 minus year 1 divided by year 1 times it by 100. That's it. Now, this is important to understand. When looking at a problem, you have to have the previous year to be able to find the inflation rate between 2 years. So let's take a second and look back at the data that we just calculated out for our CPI. You can see here we have, again, 2014 to 2019. One of the things to note here, if we wanted to find the inflation rate between years, we actually can't for 2014. The reason why is we don't have the data for 2013, so we wouldn't be able to solve that. However, let's go and do one together, and then we'll see if you can figure out the rest of the table. Let's calculate out the inflation rate for 2015. So we're looking from 2014 to 2015. What we're going to do here is take our 100, which is going to be our year 2. That's the current year we're trying to figure out what happened. We're going to minus it by the 60 because that's our CPI for year 1. Then we'll divide it by 60. We're then going to times our answer by 100, which will turn it into a percent. So we're going to have 66.6667, it's kind of repeating, percent. That would be our inflation rate between these 2 years. Is it making sense? Try to figure out the rest of the table. I'll leave the formula up there, but use our CPI that we calculated out before to find the inflation rate between each of these years. Good luck. Pause the video now. Hopefully you're able to figure it out. If you need more time, pause the video. Right now you can see the answers here. Again, this is showing us the inflation rate between our 2 years. It's important to remember that we're always going to take year 2 minus year 1 and divide by year 1. Hopefully this is starting to make sense. It isn't too bad. The math is not that hard. It's just important to remember the formulas and what to do with it. Now, I know this was a really quick overview. The goal of this video was just to kind of quickly show how to find a CPI and also calculate out the inflation rate. I hope it helped. If this video helped you out, please subscribe and support the channel. And
Okay, I'll just want to okay. Again, it is the way on how we'll be able to compute the consumer price index now. And how about the impact of deflation? So since many index bands link band principles to an inflation index, deflation can lower the adjusted principal. So during a period of deflation, the inflation-adjusted principals can fall below its face value. So, to protect investors during deflationary periods, countries such as US, France, Germany, and Australia provide deflation floors. So, a deflation floor ensures that investors receive the face value of the index-linked band at maturity. So, even if deflation caused the band's principal to fall below its face value, it offers capital protection to investors during periods where deflation can negatively affect the repayment values of the securities. However, we need to take note that deflation can lower the value of coupons calculated based on a lower adjusted principal. So most countries only provide a deflation floor to secure the original face value of the band. Let's say, for example, Australia. Australia is an exemption to this standard as Australian linkers protect coupon payments during deflation. So, how we'll be able to differentiate the performance of linked bonds versus regular bonds. No? Okay. So the break-even inflation rate refers to the difference in the nominal yield on a regular bond and the real yield on the index-linked bond. So investor choosing between a regular bond and an index-linked bond of the same maturity and credit risk, consider the break-even inflation rate. So in the inflation rate, of course, okay, so again, it is the inflation rate at which the performance of an index-linked bond will be as good as the performance of a comparable regular bond. So if actual inflation is higher than break-even inflation over the life of the bonds, then investor will earn a higher return on index-linked bonds over regular bonds. Again, if actual inflation is higher than break-even inflation over the life of the bonds, then investor will earn a higher return on index-linked bonds over a regular bonds. If actual inflation is lower than break-even, okay, the first one is higher than, this one lower than break-even inflation, investor will earn a lower return on index-linked bonds than regular bonds. Okay, so let's say, for example, if regular bond yield 3% and an index-linked bond provides a real yield of 2%, so the break-even inflation rate will be 1%. But if the investor expect inflation to be above 1% over the life of the bonds, then the index-linked bond will outperform the regular bond. So if inflation falls below 1%, then the regular bond will outperform the inflation-linked bond. Okay, so of course, we have, as what I mentioned earlier, the CFI is the official provider of the global capital market and securities analyst. No? So there are certain discussions about the high yield bond spread, consumer price index, stock, bonds, mutual funds, and some credit risk. No, I just want to play last video. I hope I could play the bond nominal versus index-linked bonds. Now, for us to have an idea again on how, because we discussed it already, the linked bond, no? The nominal bond. So this time I just want to share with you on how we'll be able to differentiate the nominal versus index-linked. No? I just want to share with you the video presentations on how we'll be able to differentiate the nominal and the index-linked.
Over time will reduce the purchasing power and therefore the value of your investments. We cover the reasons why in another animation, which you can find a link to below. Also, you'll need to understand how bonds work as an investment. There is another link below to a video that explains the basics of investing within it. In summary, bonds, which are sometimes called fixed income investments, provide a fixed payment at fixed intervals over a number of years before reaching maturity, and then the principal is returned to the investor. Bonds can either be nominal. For many years, this was the only type, and they're therefore also known as conventional, or they can be index-linked. If a bond is nominal, the amount paid out, as well as the amount returned at the end, the principal, is fixed at outset. And the same number of pounds, or whatever currency is used to denominate it, will be paid out irrespective of what happens to inflation. In the 1970s, the UK experienced particularly high rates of inflation, which had a significant impact on bond investors, such as pension schemes. And resultantly, in 1981, the Treasury began to issue bonds which provided explicit inflation protection, such that investors who purchased them at issue and held them to maturity would receive both an income which kept pace with price inflation and an uplift to their maturity payment, which took account of inflation over the bond's term. These bonds are known as index-linked gilts. Subsequently, other governments have issued their own index-linked bonds, such as the US, in which they are called Treasury Inflation Protected Securities. Although initially only available to financial institutions, index-linked gilt ownership is now available to any investor. Like nominal bonds, index-linked gilts or linkers are publicly traded, so their price fluctuates according to supply and demand. This means that an investor who buys or sells in the market rather than buying at issue and holding to maturity does not receive the explicit inflation protection, as prices at which they trade reflect the market's expectation for the future, and those may be for higher or lower inflation than the actual rate at which the bond's maturity price will be revalued. It is also worth noting that whilst index-linked bonds are one of the few assets that can protect investors against inflation, if deflation occurs, the investor who purchased at issue and held to maturity would receive less than the original.
Okay, so I think that's it for this topic. No?